I paid particular attention to Powell and his comments. And, one of the things that he did say was that nobody at the Fed is either thinking about or talking about rate cuts, which clearly the market doesn't believe. But I think that is a lie, on its face.
Peter Schiff discusses the recent stock market rally, expressing concern about its narrow leadership and lack of broad market participation. He highlights the stretched valuations, particularly contrasting the performance of the Nasdaq 100 with the Russell 2000. Schiff attributes the market's optimism to the widespread belief that the Federal Reserve won't implement further rate hikes, potentially even considering rate cuts. He argues that the market expects the Fed to cut rates by 75 basis points next year, a scenario Schiff finds insufficient. He speculates that if the Fed resorts to rate cuts, it may indicate a more severe economic downturn or crisis. Despite Federal Reserve Chairman Jerome Powell's statements denying discussions about rate cuts, Schiff dismisses them as unconvincing. He suggests that Powell's denial is a strategic move to emphasize the Fed's commitment to combating inflation, despite the apparent need for rate cut discussions behind the scenes. In conclusion, Schiff views the Fed's public stance as a form of posturing, emphasizing the challenges they face in influencing the economy given its high levels of debt across various sectors. Let's dive into the clip. Also, make sure to hit the like button, subscribe, and drop your comments below.
We had another big up week in the stock market, defying all of the fundamentals that would argue for significantly lower stock prices. Now, even though the markets rallied, it was a very narrow rally. Again, there's a handful of stocks that are leading the way. The generals are going, but the troops are not coming along with them. So all of this, I don't think, is going to end well for the longs in the stock market. The Microsoft hit a new all-time record high today. And even though the Dow was up almost 400 points on the day, the big mover again were the tech stocks led by Microsoft. But the Nasdaq 100 was up 2.25% on the day, about 3% on the week. But if you look at the Russell 2000, for example, which is obviously a much broader measure of stocks, that index is no higher than it was back in the summer of 2018. It's made no gains whatsoever, yet during that same time period, the Nasdaq 100 is basically doubled in price. So the valuations are extremely stretched. And what I think is driving this rally and the rally last week is the perception now that I think is pretty much universally accepted among investors that the Fed is done, that there are no more rate hikes coming. There's no more rate hikes coming this year, and there's probably no rate hikes coming next year. In fact, if you look at what the markets now expect, they are pricing in 75 basis points of cuts for next year. And it's my guess that they'll start to price in more cuts than that, because 75 basis points is really not a lot of cutting. And if the Fed starts cutting rates, it's because the economy is very weak, weaker than it already is, and potentially we have a banking crisis, financial crisis, or something breaks, which will require the Fed to be far more aggressive than 75 basis points. But this is why I think the market is rallying. And Powell took part in a panel discussion that I was watching that was interrupted briefly by some climate protesters. But they managed to get rid of all the protesters after a short timeout, rather comical. But in any event, they went back, and I listened to what everybody on this panel had to say, but I paid particular attention to Powell and his comments. And, one of the things that he did say was that nobody at the Fed is either thinking about or talking about rate cuts, which clearly the market doesn't believe. But I think that is a lie, on its face. I mean, how could that possibly be true? How could the FOMC members not even be talking about rate cuts? I mean, even if they don't want to do it, how can they not be talking about it? After all, what do they do over there? They move interest rates. They move them up, they move them down, right? They're either hiking them or they're cutting them. How can they not talk about the prospect of cutting rates, even if they're going to reject it? Clearly, they're talking about it. Even if they don't want to do it, they have to talk about doing it to decide that they don't want to. So why would Powell go out of his way to lie and say that they don't even talk about rate cuts? Because he really wants to make sure that the markets take seriously the tough talk about inflation, because he keeps reiterating how far inflation is from their 2% target, how much higher it is, and how much further they have to go to bring it back down. And so part of that is to, not even let the markets think that they're discussing rate cuts when, of course, they're discussing rate cuts. This is all just the BS, right? You got to talk tough because at the end of the day, they don't have any stick at all, let alone a small stick, based on how indebted the economy is, how everybody from the government to the corporations to the household sector.
In this next segment, Peter Schiff delves into the myth of the resilient consumer as touted by Federal Reserve Chair Jerome Powell. Drawing a vivid analogy, Schiff dispels the notion that consumers are impervious to economic challenges like Superman facing bullets. Instead, he paints a stark picture of a consumer enduring wounds, bleeding from financial hardships, but somehow staying afloat. Schiff unveils the survival tactics of the average consumer, revealing that the seemingly resilient facade is sustained through depleting savings and maxing out credit cards. With COVID stimulus checks depleted and credit card debt soaring to record highs at nearly 21% interest, Schiff questions the sustainability of this financial juggling act.
Now, Powell also talked about the consumer again, right? The resilient. This is his favorite word, just like, transitory was when he talked about inflation. It's resilient, right? Every time he talks, that's his word, right? Resilient consumer. Well, I mean, is the consumer really that resilient? I mean, sure, he's still spending money, but you've got to look at why. I mean, it's not like, the consumer is resilient like Superman is resilient to bullets, right? You shoot Superman and the bullets just bounce off his chest, like no big deal. The consumer is not resilient like that. The consumer is getting shot, and those bullets are hurting. They're doing damage, right? The consumer is bleeding and hurting, but he's still breathing. He's still alive. He's badly wounded, but he's resilient enough not to be dead. And how is the consumer staying alive, with all these bullets, right? Well, one way he's doing that is by depleting his savings, right? A lot of consumers, got a big boost. They got these COVID stimulus checks, and so they had those, and so they spent that. That's gone. The other thing the consumer is doing is, maxing out the credit cards. Credit card debt is at an all-time record high, even though credit card interest rates are at an all-time record high. It's almost 21% now is the average rate on credit card debt. Who would borrow at 21% if they didn't have to? I mean, if you had a choice, you wouldn't do it. But so many Americans, these resilient consumers, are putting their grocery bill on a credit card and paying 21% interest on top of the higher price for food.
As we wrap up this insightful journey with Peter Schiff, let's recap the key takeaways. Schiff has cast a critical eye on the recent stock market rally, expressing concern over its narrow foundation and the Federal Reserve's potential role in sustaining it through strategic maneuvers. Shifting focus to the so-called resilient consumer, Schiff dismantles the myth, likening the consumer's endurance to Superman surviving bullets, wounded, bleeding, but somehow still breathing. The survival strategy? Depleting savings and maxing out credit cards, with record high interest rates painting a grim backdrop to the financial acrobatics. As we navigate these financial waters, keep a keen eye on the shifting tides as the economic landscape reveals its complexities beneath the surface, and stay tuned for more deep dives into the world of finance.